I'm Whitney Tilson. I hope you enjoy this video. If you'd like to learn more about Kase Learning and our programs, just go to kaselearning.com. And if you have any questions, just email me at info@kaselearning.com. Good evening, everyone. Why don't we get started? I think there are going to be quite a few more people trickling in over the next 20 minutes or so, but we're going to start with just Glenn and me introducing ourselves. And hello to everybody who's joined us via webinar. I'm going to have to stay, the camera covers from here over to here, so I'm going to have to stay right in this range for the evening. But thanks for joining us. So let's just start with a quick overview of what we're going to cover, a little bit of introduction overview. And this is an introduction to value investing. So, you know, some of you, my friend Chris here has been one of my mentors in this business. He ran a fund for decades and was one of my first mentors in the business. So it's sort of funny and flattering, I suppose, that someone is a real legend in the business. He likes to say he labors in well-deserved obscurity, but any guy who bought Berkshire Hathaway stock at $1,876 a share and has never sold it, he still owns those shares. I think I'm done. Like, if you do that, do that once in your career and are smart enough never to sell, I don't have anything else to teach you. So there's a real range of experience in the room, but this is just sort of an introduction, assuming you don't know anything about investing. So, but we can start diving into deeper stuff if you want during the Q&A. So talking about some of the basic concepts: intrinsic value, margin of safety, the concept of letting the market be your servant, not your guide, and then dive into, you know, the sort of basic principles as we see them to being a successful investor. And then we've got a couple stocks that we'll talk about. Well, three stocks actually: Berkshire Hathaway, Google, and Facebook. So let's start. Let me just start by briefly introducing myself personally and professionally. My parents were among the first couples to meet, marry in the Peace Corps. I grew up in Tanzania and Nicaragua most of my childhood. That's me. In the upper left corner, planning to be a farmer, because I went to school with Tanzanian farmers' children. It was my first education, and that's me and my sister in the upper right. With my mom, my parents are avid horseback riders. My one claim to fame as a child was I was one of the 600 odd kids in this famous Stanford marshmallow test. Did you or did you not eat the marshmallow? And by the way, they never tell you. They're still tracking me to this day and tracking my oldest child. But they never tell you if you ate the marshmallow. So that is not actually a picture of me. There are no pictures of me sitting in front of the marshmallow at age 6, 45 years ago. Ended up living in Western Massachusetts, going to Harvard undergrad, where I met Bill Ackman, who remains a good friend to this day. That's what we looked like back in the day. Right after college, I helped the cops start Teach for America. The only real job I've had in the 30 years since I graduated from college was working 2 years as an associate at Boston Consulting Group. While there, Bill and I crashed the Harvard Law School orientation booze cruise, where we met a childhood friend of Bill's who became my wife 24 years and 11 months ago today, i.e. my 25th anniversary is a month from today. So we have 3 beautiful children, one of whom just graduated from college, is working a few blocks from here, started her career a week ago at Ernst & Young Consulting. So after HBS, I worked with Michael Porter for 5 years, starting a nonprofit called the Initiative for Competitive Inner City. And then in the late 90s, discovered investing, had paid off my college and business school debts. I had the first $10,000 in my bank account. It was in the late stages of a 17-year bull market. And it was only after business school that I really ever heard of Warren Buffett. And it was Bill Ackman who introduced me to Buffett and value investing. And I sort of took to it, and of course, every stock I picked went up because it was the late 90s, and so I thought I was God's gift to investing. And so I decided to hang out my shingle as the world's smallest hedge fund with $1 million on a rickety IKEA desk and a laptop in the corner of my bedroom, and that was my fun for the first 5 years. But I learned fast. I had absolutely no business going into this business, but I learned fast and really hit it the first 12 years or so, and built a whale of a business. Glen joined me about 5 years in. We had an 8-year run together. And then I managed to screw it all up, and maybe we can talk about that during the Q&A. But that's I'm not going to dive in. That's a long story with a lot of lessons for young people that we teach in our seminars. So that's a quick overview of me. Glen, since people on the webinar will not be able to see, why don't you walk around out here and let Glen introduce himself.
Hi, I learned to stand on this side because Whitney was blocking the pictures when he was presenting. For those on the webinar, first off, if you hit the chat button, you'll be able to send messages to us and we'll be able to answer them. So I'm Glen Tongue. I grew up in West Orange, New Jersey. Went to college at Princeton. I studied electrical engineering and I studied computer science a long time ago, but some of those teachings are still relevant. I worked in my father's company, a company called Glen Tongue Laboratories. We made electronics for cable TV. We made amplifiers and modulators and things that allowed cable TV to work. And that was my chosen career path. I worked there when I was a young kid. As I was growing up, summers, all of my school breaks throughout school. I went to get my MBA at Wharton, where I studied finance and marketing, kind of what everybody studies at Wharton. And then my dad sold his business and I had to find another career. So I went into investment banking. I went to Donaldson Lufkin Generette. I didn't start as a managing director, but I ended as a managing director. I worked in the leveraged buyout business, leveraged buyout advisory business in M&A and underwriting, which is a great training ground for stock investing because you learn the credit analysis. That's the debt analog to equity analysis. How much cash can a company generate and how much of it will accrue to the equity holders over the life of the company. So I worked there. DLJ was a very prolific deal machine, great place to work, tremendous turnover in transactions. And in 1999, when Whitney was starting his company, the internet boom was in full force, and we at DLJ had a business called DLJ Direct, which was an online brokerage company, kind of like E-Trade and Ameritrade today. We were the pioneers in that business, and we decided at DLJ to take it public. That business needed a president, so I became the president of DLJ Direct. Ran that for a couple of years, about 1,000 employees. And when DLJ sold themselves to Credit Suisse, we sold DLJ Direct to Bank of Montreal because Credit Suisse did not want DLJ Direct as a business. I worked for a couple of years at UBS after that, although in the DLJ Direct days, I completely got the investing bug. I loved investing, read everything I could, followed how our clients invested, what they did right, what they did wrong, and knew that investing was where I wanted to go. You can see from this picture, I have 5 children, and they wanted to go to college, so I went back to investment banking for a couple of years and got myself on a financial footing where I was able to leave that and join Whitney. So we worked together for 8 years, a lot of ups, a lot of downs, more ups than downs. We started out as close friends, we're still close friends, and a bunch of business relationships in between that. When we stopped managing money together, because we were doing better separately than we were together, and Whitney can talk a little bit about that, I started a little business called Deer Haven Capital. It's a little hedge fund. And when Whitney started this business, he recognized that it was going to scale and take off pretty quickly, and asked if I was interested in helping out, and I was thrilled that he did ask me that, and so here we are.
Okay, I'm just going to run through some slides quickly, just as a quick overview of what we're doing, what we're doing in Kase Learning and all, but I'm going to send you guys the PDF, so you don't need to take notes. These slides I'll probably send out this evening along with the recording. The webinar will be recorded and available afterward if you want to go back and listen to something again or what have you. The 2 seminars we're teaching via webinar starting on Friday. So we take, instead of a full day, since there's no lunch break, like 12-hour day in person, there's about 7.5 hours of content. So we break each day into 3 2.5-hour modules. So a 1-day seminar is 3 webinar sessions, 7 to 9:30 a.m. For example, the How to Launch and Build an Investment Fund, we're doing Friday, Monday, and Tuesday. 3 sessions in the morning. Anyone can sign up, because we don't have to rent a room like this and buy food and all of that, and sort of price it at half the price of our in-person program. So we've got two of our seminar webinars coming up Friday and all of next week. We're doing an in-person program here in New York, September 24th to 28th, and then we're doing the webinar, all 3 of our programs over 15 webinar sessions starting on October 29th. So if any of you are interested, contact me, and I can give you our best early bird pricing and discount for coming here tonight. So let me know. And we're also doing a conference on short selling on December 3rd. This is just a best ideas conference. Invite smartest short sellers in the world to come pitch their best short ideas. We did our first one on May 3rd, and I was in the conference business for 10 years. We did 20 conferences called the Value Investing Congress, and I think we get more fun, move more stocks, people learn more at this conference. Nobody's ever done a conference. What is value investing? Attempting to buy a stock or another financial entity, buy anything if they didn't think it was, if it was one of the world is engaging in without any real sense of what it's truly worth. And then they're hoping to sell it to somebody else in 3 milliseconds or 3 days or 3 weeks or something to somebody else for a higher price. That's how the vast majority of money in the world is in fact managed. So there's often people think about, oh, value investing is the opposite of growth investing, and it's not. All sensible investing is value investing. The smartest growth investors are in fact value investors, i.e. they're just willing to pay a higher price, betting and trying to find a handful of companies that can really grow into a high current valuation. But value investors have made a lot of money owning growth stocks over the years, smart value investors. In fact, one of the mistakes I made, I think Glen would agree, he made in his career is sort of being too dogmatic and saying, oh, I'm never going to pay more than 20 times this year's earnings for a company or something like that, and not being willing to pay up for growth. Well, there are some companies that have growth profiles that make them a good buy, and even value stocks. In fact, we're going to talk about Google and Facebook, 2 stocks that are clearly would fall in the traditional growth category, but we think are value stocks today. Value investing also does not just mean buying lousy businesses at low valuation multiples. That is a traditional, I would say, value investing approach, but good value investors don't get locked into that. So let's talk about some of the key foundational principles of value investing. The concept of intrinsic value. And this all comes from the Bible of value investing, Ben Graham's book here, The Intelligent Investor. So intrinsic value is the true value of a company or an asset based on all aspects of the business, both tangible and intangible. Typically, it is estimated by projecting future cash flows and then discounting them back to the present. So intrinsic value is rarely a precise number. It's usually a range. And sometimes be a pretty wide range. It can be very difficult to predict a company's future cash flows, and there's a lot of uncertainty. Keep in mind, intrinsic value is not the current market cap or whatever the company was, if it was a private transaction. In fact, margin of safety from chapter 20 of the Intel concept. If you're building a bridge, and you're gonna have trucks going over it, and the trucks collectively weigh 20 tons. Don't build a bridge that holds 21 tons. Same principle applies in investing. If you think 17, and as Ben Graham wrote, decades ago, calculations are worse than average luck. You want a big margin of safety. Sometimes you're wrong. You don't want to get clobbered if you are. So the other key concept from chapter 8 of The Intelligent Investor is letting the market be your servant, not your guide. So you should understand that stock prices are going to fluctuate wildly. And if you just look at the stock price and you own something and it goes down and you despair and blow it out just because it's going down, you're letting the market be your guide. And instead, you need to understand the value of what you own. And then if the market makes a mistake, and the average stock ranges about 50, and the value of businesses does not. What that means is the market's probably underpricing it at some point every year and overpricing it. I mean, it could be somewhat overvalued and massively overvalued. That could be a range, relative to intrinsic value. But the key here is understanding that the market can be very crazy at times, and your job is to ignore it, to stick to your guns in terms of your analysis and estimating what businesses are really worth, and then take advantage of market's mistakes at times. So let's talk about, those are the basic foundational principles. Let's talk about what's a strategy. So if you want to be an investor, whether you're just picking stocks on your own, or certainly if you're going to try and do this professionally, you need to have a strategy. So start with a careful, honest self-assessment. Ask yourself some key questions. What am I interested in? What do I enjoy? What am I good at? And what's my edge? So rooted dates, are you from a different country? Might you have expertise in that country or something like that? If that's what you're interested in, that's where you have an edge. If you speak the local language, what have you, right? Are you going to engage in any short selling? And if so, to what degree, with what kind of strategy? What's your overall exposure? Are you going to be long short, long only? You're going to hold a lot of cash? How concentrated are you going to be? You're going to be a 5-stock investor, a 50-stock investor? How much trading do you plan to do? What's your average holding period? Are you going to invest only in stocks, or how about distressed debt? Other asset classes? You got to answer all those questions to develop as part of your strategy. And if you're going to try and do this professionally and try and raise money from people, then you're going to have to make the case to those people that the strategy makes sense and it's consistent with what you have a chance to be good at. So now you've got your strategy. Now you've got to go out and execute, and fundamentally that's good stock picking, right? That's not all of it. Portfolio management is huge critical skill that I did not fully appreciate, and that's something we dive into pretty deep in our boot camp, but cover in the intro seminar today. But let's just talk about, good stock picking, good market timing, or leverage. There aren't that many good marketers out there. Instead, profits get cut in half. You're going to make a lot of money shorting that stock. Okay? So it's all you're doing is, as an investor, is you're betting against the herd. The herd is the consensus expectations. So where do you find situations like this? Let's just talk about long investing, which is hopefully you guys will all be smart enough to stick to the long side. Even though we teach seminars and host conferences on the short side, my advice to most of you, I could save you all a lot of time and energy. Just don't do it. Just don't short. But for some people, it makes sense, and for a variety of reasons, and that's why we teach it, because nobody teaches that either. And we had to learn a lot of things the hard way. So where do you find cheap stocks that outperform their expectations? And you know, the stock goes up a lot. Well, the classic value play is finding companies that are encountering some difficulties, that are out of favor, earnings are down, and the stock's down 75% or something, but the problems prove to be fixable. And that's the thing, it's super easy to find companies that are in the toilet right now. You know, look at any mall-based retailer, for example. The problem is most of them are going to zero, right? So they look cheap on every metric. They're certainly beaten down. But the problem is the market, the reason the stocks are cheap and the stocks are down a lot is because the market predicts that their profits are going to continue to decline. Well, guess what? If profits continue to decline, stock certainly isn't going up. It's probably going to keep going down, right? It's your job. The key is to find the occasional situation where the market's just completely wrong and they think the company's going to zero, and instead a new CEO or something comes in and things turn around, right? So look at Best Buy. You know, Amazon, Circuit City went to zero. Amazon was, you know, they're selling electronic gadgets that you can just buy on Amazon, and the stock got obliterated like so many other retailers. And then a new CEO came in with a brilliant strategy, executed it well, and the stock went from 15 to 75, right, today. It's been a monster stock, right? Finding the occasional company that everybody thinks is roadkill, but then turns around. Go look at Restoration Hardware a year or two ago. Again, Amazon roadkill, you know, running these big expensive stores and doing these big fancy catalogs, you know, surely roadkill with Amazon and Wayfair, et cetera. And instead, the stock's gone from 26 to 140 in the last 18 months, right? So classic value investing is finding beaten down, out of favor stocks that the fundamentals turn and the market is not expecting them to turn. And then you get a double benefit. Profits go up and the multiple on those profits go up. And so, you know, the profits double, the multiple doubles, and now you've made 4 times your money, right? That's what value investors dream of. But one of the things, and that's what Glenn and I tried to do for most of our careers, what we really whipped on in most cases was a case where the stock isn't beaten down. It's not out of favor. Companies are doing great, but you know, the natural rules of capitalism are, you know, companies with very high margins and very high growth rates, those two things get competed down because new competitors enter, et cetera, right? Very, very, very few companies grow their revenues, for example, at more than 20% a year for any period of time. Well, there are a handful of companies, though, that the rules of gravity, of capitalism gravity, haven't applied so far anyway. You know, Amazon, Netflix, Facebook, Google, you know, where the market was, you know, projecting, hey, these are great companies, they're trading at high multiples, but surely that growth rate's going to come down. And that was the projection. And you know what? The growth rates accelerated. They didn't just stay high, the percentage growth rates accelerated. Those stocks are going up. At any price, those stocks are going up. If, in other words, so sometimes it doesn't, you know, one of the things that our minds were way too closed to was finding a handful of truly exceptional businesses that could just grow and grow and grow and grow, that had business models that didn't require a lot of capital, inventory, et cetera, and we missed almost all of those, and shame on us. We should have been more broad-minded about that. So you know, there are a lot of different ways. The core principle, though, whether it's a turnaround situation or just a long-term growth situation, et cetera, is figure out what expectations are built into the stock, and be very, very, very sure that the company's actual performance going forward will materially exceed those expectations. You're going to make money. So in many ways, if you summarize, what does that mean? It's called a variant perception. It's a term Michael Steinhardt coined. And all you got to do is have a belief that's out of consensus. That's easy. And be right. That's hard. Okay, and that's called a variant perception. Okay, and you better be very clear. Every single stock you ever buy is what's your variant perception, and then why are you convinced that you're right and all the other really smart investors and supercomputers are wrong. So that's effectively the bet you're making. So what's the process? Here's my process. I have this taped up to my wall next to my desk. Number one, so I look at tons of new ideas a day. Just open up the newspaper, go to Seeking Alpha. There's no shortage of investment ideas. We're drowning in investment ideas these days, right? So how do I filter them? Number one, is this something that's in my circle of competence? Do I have some understanding of the, if not the company, certainly of the industry, or do I think it's an area that I can build that expertise? So, if you come to me and show me the leading bank in Uzbekistan or somewhere trading at 0.2 times book and 4 times earnings, paying a 6% dividend yield, I'm gonna be like, great, knock yourself out. But I'm not, like, my level of analysis stops right there. Okay, it's just outside of my circle of competence. Some emerging biotech company with some exciting new drug trials or whatever. There are value investors who've done extremely well focusing on that niche. I am not one of them, and never will be. So being very clear about what your sweet spot is and where you can develop an edge and develop some insights that are out of consensus is super important. So that's question one. And by the way, feel free to, if anyone wants to weigh in with any questions and all. Number two, company and industry evaluation. And I wouldn't say there's a lot of rocket science here. I'm asking questions about the company, its sustainable competitive advantage, high returns on capital, growth, balance sheet, strong free cash flow, and then some questions about the industry. Are the trends favorable? What are the competitive dynamics? Ideally, I'm looking for an informational edge, often via proprietary sources or scuttlebutt research. So one of my students, been in the business a long time, 20 years out of Harvard Business School. She's in the process of starting up her fund right now. And she is a consumer specialist. She has a lot of contacts in the industry. She reads all the fashion magazines. She shops at all the stores. She knows in all the years, she was always my go-to person anytime I was looking at a retailer. I'd say, what do you think of this company, that company, whatever. And I never once stumped her. She always knew the whole situation. So she's got an area that she's really passionate about, that she's been 20 years becoming the world expert on, and developed proprietary insights and invest very successfully long and short in this space, right? So she's doing this basic analysis, but she limits herself to an area in which she has developed real expertise based in genuine interest. And it's always best to find something you're personally really interested in and passionate about, right? So then the third question after you evaluate the company and industry is the management. And you're asking 3 questions. Are they good operators? Are they good capital allocators? And are they trustworthy and shareholder friendly? And keep in mind that most people become CEOs of companies because they're good operators, not because they're good capital allocators. Most of them are sort of empire builders and often screw things up with bad capital allocation. But making big dumb acquisitions would be sin number 1. Doing very poor share repurchases would be another. Elon Musk is violating, with a very high price stock in a company that's burning huge amounts of cash and an increasingly indebted balance sheet. Why they have not done an equity offering to de-risk the business is beyond me. That company could go under due to bad capital allocation. So now let's just say I found a stock that I understand super well. I understand the company and the industry really well. I've done my analysis, and it's a great company with great future prospects in a favorable industry, and management is great all around. So I buy it, right? So what's the last part? The price. The price, right? So actually, Chris, this is the second point is Chris, I got this phrase from. Are you trembling with greed? Did you originate that, or is that?
I did.
You did. All right. There you go. Well, I don't know if you know that I've stolen that phrase from you, And I've been teaching it like, you know, Chris once described it to me as you want to wait until you find a stock that you're trembling with greed. You just can't believe that the market is giving you the opportunity to buy this at such an incredible price. Now, the one downside to it is there were trembling with greed stocks. You could throw a dart and buy trembling with greed stocks in late 08 and early 09. And then the market started to recover and stocks started rallying. And I kept waiting. So I sold, and as stocks went up a bunch, I sold it. I sold the stocks and built up cash. And I haven't found very many trembling with greed stocks since then. So I sat on a lot of cash and I just trailed this long bull market. So there's a downside though. If you really are waiting, trembling with greed and finding 50-cent dollars, well, you could just be sitting there in cash for a lot of years. It's not, so there's a balance there. You know, sometimes being willing to pay up for high quality businesses. I did own Berkshire during this whole period, and since late 08, early 09, Berkshire I wouldn't say has been a trembling with greed stock. Today it's about a 90-cent dollar in my estimation, and I still own it. But that's the tension. That's the tension, particularly if you're managing money professionally. If you're just managing your own account and you're not finding anything cheap, fine, just own an index fund or just sit on some cash, right? But if you're managing money professionally, it can be very tough. If you're really trying to buy only 50-cent dollars, then there just aren't any 50-cent dollars out there. Certainly not in the ponds you're fishing in. I mean, I have no doubt that there are plenty of 50-cent dollars if you're really smart and know what you're doing in less efficient pockets of the world. You know, if you're investing in India or, you know, some, you know, more frontier markets or emerging markets. But here in the United States, which is mostly where I invest, it's, you know, being willing to pay up for 80-cent dollars may be the best thing to do, and wait for things to get cheap. Yeah, Chris.
You do the best work on Berkshire Hathaway, anyone. And we've done it historically by actually quoting more and how he values things. Would suggest that you might be overlooking it now, but we aren't. They're buying the stock in the open market. Instead, you wouldn't buy it unless it were at least 20% below intrinsic value, suggesting, according to his reasoning, the intrinsic value is more like $400,000, so $320.
Yeah, yeah. We're going to come back to that. We have some Berkshire slides. Once we sort of go through this overview, we're going to try and bring some of these concepts to life by looking at 3 current companies. So let's come back and talk about Berkshire specifically. And yeah, I don't think the market has fully picked up on the significance of the fact that Buffett just disclosed last week that he's been buying back Berkshire stock at roughly today's levels, north of 1.4 times book. I think there's a new soft floor in Berkshire stock that makes it particularly interesting. You know, it may well be all right, so maybe it's an 85-cent dollar, but it's an 85-cent dollar with a new soft floor on it that didn't exist before, when he was only willing to buy it up to 1.2 times book. So we'll come back to that. So let me just talk about, so now you found something, you're trembling with greed, huge margin of safety, stock is really cheap. You probably want to concentrate your portfolio in those best ideas. Certainly in a market like today, if you're trying to own 50 stocks or 100 stocks, there's no way you're going to find 50 or 100 stocks where you're really trembling with greed. And so this is not necessarily, I know plenty of value investors who own pretty diversified portfolios, but generally speaking, I think owning, you know, somewhere in the 10 to 15 stock range, not the 50 to 100 stock range, is going to serve you well. Chris, how big was Berkshire in your portfolio for the last 40 years?
The last 33 years, on average, it was about 33. I'm sorry, on average, about 40%.
Yeah, 40%. For those on the webinar who can't hear, Chris Staver's a legendary old timer in the business who bought Berkshire under $2,000 a share years ago, still owns those shares, and ran a hedge fund for 20 years or 30 years.
More old timer than legendary. This is 1978, basically.
1978 is when you started, was when you set up a fund.
The predecessor of
Yeah.
Savin Partners, and 95% of the money at the end was from the original.
95% of the money from the end was from the original capital. So you did not have much of a marketing effort underway over the years.
No. As you can see.
But Chris did a lot of smart things over the years, but he identified Warren Buffett's, I've been to the last 21 Berkshire meetings. Chris been the last 34, 33? 33 meetings. So Chris, one of the few people in the world who's got me beat on that front, but he figured out one thing very, very, fairly, not early, you weren't a teenager, you were well into your career, but you figured out one thing, that Warren Buffett was very unusual, and the Berkshire Hathaway was very unusual and very interesting, and this is something to do in size and never sell. And that's the only decision he had to, he made a lot of other smart decisions, but that's the only one that he had to make, and he did it right,
It was blindingly obvious, but I did not have the experience to see that it was obvious.
But you had enough experience to hold it and to buy it and hold it. Yeah, question.
Yes. How do these numbers change if there's dramatically higher volatility with the stocks? Small caps, emerging markets.
Yeah.
There's clearly variance.
Yeah. I do not recommend that you put, like Chris did, 40% of your fund into, one of our students was talking about a small textile company in India where the stock was down 80%. And when he bought it, and we all laughingly said, the definition of a stock down 90%, which is stocks down 80% that then gets cut in half. So he had the stock cut in half, it was now down to 90%. And it was actually a pretty interesting situation, and the guy's from India and has some knowledge of that and all. So we were that was this is the kind of in-depth thing we sort of dive into in our boot camp, for example, is, how do you manage a situation? How do you size things? What do you do when you get in and it turns out you caught a falling knife and it's fallen some more? We have a great case study on SodaStream, which I pitched at a big conference at $36 a share. 8 months later, it was down to $21 a share. So I pitched at an even bigger conference. And then another 6-8 months later, it's at 12. I pitched at 36 and 21, and then it was at 12. What do you do? Because, it's tough enough if you're just doing it on your own or with your little fund. It's a lot harder when you publicly touted it and written articles about it and spoken at conferences. This is, usually, by the way, the market is right. Usually you're getting killed on a stock, it's because you've missed something. In fact, that has to be your working assumption going in. If the market's telling you you've made a mistake, odds are 90% you probably have made a mistake. In the case of SodaStream, though, I hadn't. I was just early. Bought more all the way down, and it just got bought out by Pepsi at 140 18 months later, from 12 to 140. Right, so sometimes it pays to have courage, even if you're early, right? But figuring out, okay, what's SodaStream and what's Valiant, which went down 97%, just absolutely incinerated 5 of the smartest investors in the world. Those are case studies we teach in our seminars. So your question is good. This gets to the portfolio management piece that, again, I did not fully appreciate as a young investor. You think it's just all about being a good stock picker. It is as much, being a successful investor over time is as much about being a good portfolio manager, sizing things properly, knowing when to trim, knowing when to get the hell out, knowing when to double down. And it's not knowing, it's having just good instincts and trying to get those decisions, more than half of them right? There's never any certainty. So just a couple thoughts. So on valuation, that's the key here, right? Is buying things that are cheap. So how do you value things? Again, we could teach, we teach much more in depth on this in our programs, but just want to sort of give you the highlights. How do you value things? In most cases, you want to stick to cash flows. Use a discounted cash flow. And I wouldn't suggest doing a lot of super complex Excel spreadsheets. Like we're going to show you Facebook here, right? How well Facebook stock goes from here you don't need a big spreadsheet. You just need to think sort of sensibly about, okay, the sentiment sort of turned on the stock. It's down 26%. It's, was trading at 50 times earnings, is now trading at 23 times earnings. And thinking about, okay, where's this stock likely to be in 3 to 5 years? And it's a function of revenue growth, it's a function of margins, and it's a function of multiple. Okay, because revenue growth times margins equals earnings times a multiple on those earnings. That is your stock price. Okay, that's all super simple. Okay, so thinking sensibly about what some of the key drivers are, and is the company sandbagging its guidance, for example, on margins or not? What incentives would they have to sandbag guidance, et cetera? Those are, thinking sensibly about that. It all comes back though to a discounted cash flow. Okay, what are the cash flows that Facebook is going to generate? But then comparing that to what the expectations are today. So I suggest when you're doing valuation work, 90% of your effort should be thinking about future cash flows. But let me give you some of the other tools in the toolkit. Other public company comps, if you're looking at a company that's trading at 10 times earnings and all its peers are trading at 15 or 20 times, maybe because your company's out of favor. I can't tell you, I've invested in the fast food sector many times over the years. So, Wendy's, McDonald's, Burger King, et cetera, Denny's, CK restaurants, Yum brands. It's amazing how, Wendy's was the total out of favor, ugly stepchild trading at a big discount. And then they do some things and the tide turns, and a few years later, they're the ones trading at 20 times earnings and the peers are trading at 15 times or something like that, right? For years, look at Morgan Stanley, always traded a big price to book multiple to Goldman Sachs, and now that's reversed. Morgan Stanley's come into favor. Goldman trades at a discount relative, go figure. So looking at public company comps can give you some hints anyway as to whether something might be cheap. Looking at acquisition comps, if there's a lot of activity in the sector, can be useful. Particularly useful to thinking about if you're thinking about shorting something. You think, oh, this thing's stupidly overvalued at 8 times revenues. Well, if big companies are buying smaller companies in the sector at 10 or 12 times revenues, you're likely to get incinerated. If you're shorting something because on valuation, because it looks high at 8 times revenues, right? Historical comps, thinking about where stocks have traded historically on price to book, price to revenue, but most importantly on earnings or cash flow basis, and thinking, might it return to prior levels if you're looking at beaten down stock or not? Have things fundamentally changed? Doing the sum of the parts. A classic case was Bill Ackman's activism probably 10 or 15 years ago with Wendy's. They owned Tim Hortons. So you had a burger business and then you had a Dunkin' Donuts / Starbucks kind of business, which is Tim Hortons up in Canada. Fabulous, fabulous business. And the entire stock was trading at the value of the Wendy's business. And Tim Hortons was being valued at 0 within Wendy's, and Bill Ackman came in and laid out the case and said, you got to spin off Tim Hortons, and Tim Hortons by itself is worth the current stock price. And sure enough, he was able to pressure the company and spinning it off, and the stock doubled in a year, right? So that's an example of some of the parts, particularly if you have a company that has a money-losing business. You'll see in our analysis of Google. Google is investing billions of dollars in these so-called other businesses like Waymo, et cetera, that are dragging down reported profitability. So the way we think about how much Google is worth is that Google could very easily sell off or just shut down any money-losing businesses, but they're probably worth, Waymo's, the autonomous driving, if it were spun off or sold to somebody else, could be worth a lot of money. But all it's doing within Google is dragging down Google's reported profitability. So we think Google's actually trading, if you X out those investments in these big bets, Google's trading a lot cheaper than it appears. So and then sort of some rules of thumb. Be careful here. Probably helped me in some areas, got me in trouble in other areas. About generally speaking, I liked to pay 10 times earnings for good businesses, and never would pay more than 20 times earnings. And by having those rules of thumb, it kept me out of some things where I might have gotten burned, but it also kept me out of things like Google and Facebook and Amazon and You know, I was in Netflix and then I sold it after it went up 5x and then it went up 10x after that. So I missed a 50 bagger because of my rule of thumb, right? So, so be careful about rules of thumb, but if they're smart, they can help you. So Glenn, do you want to come talk about Berkshire and I'll talk about Facebook and Google? How do you want to split these?
Sure.
Sure what?
I'll come up and do Berkshire. And
Okay. Here you go. So we're going to, yes, please.
If people fly, when you say 10 times trading earnings, does that mean the PE ratio will be more than 10?
Correct. Now, keep in mind, you know, sometimes I'm investing in businesses that are going through tough times and they're losing money. So there is no PE ratio, and sometimes that's the best time to buy them. But so that's why I put in the word normalized. And, you know, for a lot of years, the 10 times, you know, looking for decent businesses, maybe not, you know, you can always buy really crappy businesses at, you know, 5 or 6 times earnings, but I didn't want to own those because I thought the earnings would go down and those would be value traps. But finding good businesses trade 10 times earnings. You know, I actually went back and I looked at some of my trades my first year or two when I got into the business. This was at the peak of the internet bubble. And the single stock had I just bought it and held it. I owned some Amazon, I owned some Apple. They then went down a lot. Amazon in particular, you went down 80% before being a 150 bagger. But you want to know, I actually found one of a stock was up is up 72 times in the last 18 years or so. Ross Stores, of all places, Ross and TJX, you know, sort of discount apparel companies. I remember I wrote about Ross Stores. I wrote articles about it. I owned the stock and pitched it, and I've got a growth business or whatever. I went back the other day, the stock's up 72x. Who would have thought if I just held Ross Stores, you know, it would have made millions, right? And it was trading, I don't know, it was trading at 7 or 8 times earnings at the time. And I don't know, it ran up and was trading at 10 times earnings and I sold it. Shouldn't have done that.
But high quality businesses are certainly worth more than that. And lower quality businesses are certainly worth less than that. And how you define a high quality business, you know, is another couple hours. But if you've got a company that's earning, that's trading 10 times earnings, it has to reinvest 120% of earnings in capital expenditures to continue operating. You know, 10 times is way too high. If you find a company that's trading 10 times earnings, you have to reinvest nothing, and they're going to have some wind at their back from a growth perspective. You know, that's a great buy, right? Because that's a 10% dividend, cash dividend yield, which I don't know other places in the world to get 10% cash dividend yields. So
yeah, I would suggest not having these rules of thumb generally. One of our guest speakers, a guy named Enrique Beta, a very smart guy, who spoke at our shorting conference and worked at a number of different hedge funds, you know, and is a great long and short investor. And he said, look, I'm not a value investor, I'm a make money investor. And all that means is I'm looking for businesses where earnings today are $1 and I think they're going to $5. I don't care if it's 2 years or 5 years, but earnings are going from $1 to $5. And I'm looking at short stocks where earnings are $5 and I think they're going to $1. And I don't give a shit about valuations, okay? Because if earnings go from $1 to $5, I know the stock's going up. I don't care what the valuation is today. The stock's going up, and he's right. I challenge you to show me any business on earth, any stock on earth, over a time period in which earnings per share went up 5x and the stock did not go up a lot. Okay, maybe it didn't go up 5x, maybe it went up 2 or 3x. You're still pretty happy, right? And I challenge you to show me any business bought at any price, I don't care how low the multiple is, where earnings went down by 80% and stayed there. It wasn't just a 1 quarter thing, right? Earnings went down by 80% where that wasn't a great short, right? So he's much, and I think that's pretty smart. I think that's pretty smart. Thinking about you want to own stocks where earnings are going up a lot. Now, obviously relative to expectations. You know, most businesses, you know, profits don't go up 5x, and just buying something where, you know, earnings double over 5 years, that's 15% a year. Well, you can lose money on that, right? Because if your starting point is 50 or 100 times earnings, because investors are expecting much higher growth, you're going to lose money if it only grows 15%, right? So, but something that goes up, but spending 80, 90% of your time thinking about what's going to happen to the profits of this business in the next few years. That's where you spend 80 to 90% of your time, not on, gee, is it trading at 10 times, current year's normalized earnings? If it trades at much more than that, I don't want to buy it. Those were blinders I had on for way too many years.
Growth cures a lot of sins.
Yeah. And I've been dumb enough to be short high growth situations where, and that will burn you unless something happens to stop that growth. You don't want to be short that. And in fact, you want to be long it. Other questions? Yeah.
Just a quick follow-up on what is your view of substituting the PE ratio with the PEG ratio?
Okay, just the question for those who might not have heard it on the webinar is the PE ratio versus the PEG ratio. And the PEG ratio, basically, for those who might not have heard it, is PE growth, price to earnings growth. And the idea is if a business is growing 20% a year and it trades at 20 times earnings, you divide one by the other, that's a PEG ratio of 1.0. Generally speaking, if you buy things with high PEG ratios, is the high PEG ratio you want, right? So in other words, the earnings, if it's growing at 30% a year and trading at 15 times earnings, that's a 2.0 PEG ratio, and that's attractive, right? You want things with a high growth rate, low PE multiple. I don't use that. I don't use the PEG ratio. I've seen it totally misapplied where a very small company is growing at a very high rate, 50% a year for a year or two, and then investors are like, okay, well then it's worth 50 times earnings, and therefore I can buy it today at 35 times earnings. And the problem is well over 90% of high growth stocks, the growth totally stalls out and the stock collapses, right? So if you are going to do growth investing and betting on growth, great, but you better be darn sure you found the 3% of companies maybe that really can grow 20+% a year, year after year after year. Those businesses are worth paying up for, but they're pretty darn rare. And there are a lot of phony businesses that look like great growth businesses and they turn out not to be, right? So that's why growth investing is so dangerous, right? Because any miss, there's a lot of room to fall before value guys, traditional value guys are going to step in and buy it, right? So, generally speaking, I prefer buying businesses that I think are going to do real well going forward, but nobody else does, and therefore the stock's super low. And then if they do sort of crappy, the stock doesn't go down because the expectation is that they're going to do sort of crappy, right? That's my preferred stock. But there are a few growth stocks that I was there pretty early and I still beat myself up for missing them. Or in the case of Netflix, where I didn't miss it, I beat myself up for not riding it. The story was playing out beautifully. It doubled and I sold half my position. It doubled again, sold half my position, and halfway to the next double, I blew it out. And I thought I was a great big genius, making 5 times my money in 18 months. And in the 5 years since then, it's up 10x. It's up 50x from the bottom, 6.5 years ago. And I was right there.
Quick question. So you were able to identify Netflix as it was becoming a monster, fast-growing company.
Yeah. By the way, it had fallen by 80%.
Yeah. But then, how do you not take those principles of what you saw at Netflix and not see any capable to see Amazon or Google?
I forgot my favorite hat. I should have brought my favorite hat. My favorite hat says I'm an idiot. And the answer is look, Netflix, I still had my value investor blinders on. Netflix was a little unusual in that I went out, and Glenn and I went out and had brunch with the CEO. And so we sort of felt like, we had some extra conviction in management and had some access there, whereas a small fund. But it made us nervous. And it shouldn't have
But
made.
there were metrics that you could tether to that you would say, as a value investor, that makes total sense. Netflix was trading at $100 a sub, where the world was trading at $1,000 to $2,000 per sub. There were
Sub being subscribers.
Right.
One way to value subscription-based businesses is look at the number of subscribers divided by the market cap divided by the number of subscribers. So Netflix at the bottom had 30 million subscribers, had a $3 billion market cap, i.e. was being valued at $100 a sub. And what Glenn was saying there is Hulu had just done a private transaction. They had 2 million subscribers. They had a private transaction valuing the company at $2 billion. So Hulu had 1/15 the number of subscribers, 2 million versus 30 million, and had just transacted between two cash-paying, sophisticated corporate owners. They had transacted 10% of Hulu in a cash transaction at 2/3 the market cap, 2 billion versus 3 billion, i.e. Hulu was valued at $2,000 a sub, and Netflix was trading the public market at $100 a sub. So there was a valuation metric there. So by the way, so in a world of, no, I take it back, it's not 2,000 sub, $1,000 sub. 2 million subscribers, $2 billion market cap for Hulu. So it's $1,000 sub. So Netflix was trading 1/10, a fairly reasonable valuation metric that we were looking at. So after it went up 5x, should I have sold? So at what value per sub was Netflix trading at that point? Gone up 5x. So you're thinking, okay, $500 a sub, except subscribers are growing 30% a year. So a year or two later, subscribers had already grown by 60% or something. So Netflix was trading $300 a sub when I blew it out, in a world where a vastly inferior business had still traded at $1,000 a sub. And I blew it out trading $300 a sub. Why? Because it went up 5x, and I thought it would be greedy to stick around or something. One of the big lessons I'll give you is be fucking greedy. Okay, if you find something that really, Chris was greedy on Berkshire. He found Berkshire. Did he blow it out after it doubled? No. Did he blow it up after it went up 5x? No. After it went up 10x? No. After it went up 50x? No. After it went up 100x? No. He still holds the shares he bought at $1,876 a share, and the stock's at $324,000 a share.
Too dumb to sell. Let me ask you a question about Netflix, which I do not follow, but looking at it from a distance, I seem to recall that they were doing very well with House of Cards.
Yeah.
And there was no way they thought there was no way they could renew a similar cheap price. And if you looked at what their subscribers were paying, I think it was $10 a month, and their two main competitors, Sirius XM or Twitter.
Well, Hulu is probably, and then Amazon Prime's been giving it away. Sirius XM's in the radio space.
But still, if their subscribers were $15 a month, I don't even know who else in the business, but I recall the numbers being roughly $15 a month. And surveys showed that people preferred Netflix. So the argument then would be, well, Netflix can certainly charge as much as the competitors do. If you assume that it wasn't selling 30 times what it was selling 17 times.
Yes.
I heard that from you, I think.
Yes. I mean, there were so many, everything that was key to turning around, which was high subscriber growth, pricing power. Netflix was $6.99 a month or $7.99 a month, and every year or two they moved that up $1. That's just pure profit, right?
Who's canceled their Netflix once it went up $1 a month?
Yeah. Like I could tell from my own experience, my daughters and so forth, Netflix had doubled their price and it wouldn't have made any difference, right? Very sticky. They were developing their own content like House of Cards. That was playing out beautifully. Like everything played out. If you're in a situation and the story remains intact, okay, all the things that you were betting on are just playing out magnificently, even better than you could have hoped for, right? And the stock's flying. I mean, obviously you need to manage position size, right? Now, if it's something like Berkshire, let it become very big, right? Because it's just safe. Right? Something like Netflix, I don't beat myself up for trimming Netflix as it went up, but I should have just ridden it and kept a certain size position, maybe 3%, maybe 5%, whatever. I had a friend who let it run up to 15%. He would trim it back, but kept it at 15% as it doubled and doubled and doubled and doubled, right? So how do you manage the toughest decisions in investing are what do you do when a stock's really moving? Now, the high class problem is what do you do when it's moving up? And you may think, okay, well, if I screw that up, so what? I still made a lot of money. But no, I would still be in business and riding high and have an extra $10 million in my bank account if I just let Netflix run. So in other words, probably the single biggest financial mistake I made in 20 years was not letting Netflix run, right? Even though I made 5 times my money. Okay, but the hardest decision, so it may well be the most costly, biggest mistake you make financially, is being in companies like Ross Stores that went up 72x, like Amazon that went up 200x, et cetera, and selling them. But those ones don't cause you too much loss of sleep because you made some good money, right? The hardest decisions that cause you to lose sleep are the opposite problem, which is you're in at SodaStream at 36, and now it's at 21, and now it's at 12, right? It's going down and down and down. What do you do? There's no simple answer. The answer is it depends. But this is where having experience, judgment, and also good mental discipline to not let your emotions overwhelm your logic. Because I can tell you, when you're losing a ton of money, especially on something you've been really public on, your brain turns to mush. It just becomes this swirl of emotions that can cause you to make really bad decisions. Exhibit A would be value.
Hey, Whitney, can I ask a question? So I'm actually one question. I'd like to add 2 points to your Netflix comment. One is that the other metrics, because I happen to be in technology and media industry. One is the lifetime value.
Yes.
So another thing is that all these subscribers, they won't, like Chris said, they won't just cancel because the price change or something. So the lifetime value actually is very high. Even though they decide to switch to a competitor after a couple of years, they already paid a lot of money to Netflix. The other one is customer acquisition cost.
Yes.
It seems to me that when the business scale up, actually the customer acquisition cost become just going down quickly. Now if they start to go internationally, I mean, you don't even need like marketing effort. Everybody knows Netflix already.
Yes.
Yeah, heard from a friend. They don't even have to spend a dime in order to
Yes.
include you to the business.
Yes.
So I think that's another power they have.
That's absolutely true. And in the case of
Here,
Netflix,
Glenn, if you're going to speak, come online, come here so people can see.
sure, that's absolutely true in the case of Netflix. As you say, the lifetime value of the customer was the $100 that Winnie talked about versus the $1,000 that Hulu traded at versus cable companies, I don't know, $3,000 or $4,000 per subscriber. The reason that those trade in the M&A marketplace at those sort of valuations per subscriber is because that's the implied, that's the calculated lifetime value per customer. And by the way, Netflix today, it's sort of interesting, right? Because it's 140 billion.
150, 160,
It's come down.
and oh, it's come back a little.
Yeah.
Okay.
So it's about a $140 billion company, and how many subs now?
About 140 million subs. So what's the math? What's Netflix on about enterprise value or market cap per subscriber today? About $1,000 a sub. So here we are 6.5 years later, and Netflix has finally gotten to the valuation level that Hulu traded at 6.5 years ago. And if you just figured that out and held on and just say, you know what? Yeah, that $1,000 a sub sounds about right. I'm going to hang on till it gets to $1,000 a sub. You're already 50 times your money.
Does that mean you keep on holding Netflix right now? You would consider selling?
If I were running, what I would suggest is if you ever have a moonshot like that is sort of figure out what level, how volatile is the stock, what's the downside if they blow a quarter, how much could you lose overnight, et cetera. And just figure out what that number is. And for me, it would probably be 3 or 4% position on the way up. And that's sort of that's the way I played SodaStream. At least I had a bit of a learning curve. I owned, I don't know, 2.5%, 3% position on SodaStream as it doubled and doubled and doubled. So, but Berkshire is something you can let double and double and double as it's a 10 or 20% position. Or if you're really smart like Chris, let it be a 40% position. But that's, there are very, very few stocks I would suggest, letting run up to that size.
I mean, Netflix is, frankly, it's kind of hard. You said right now, do you want to buy Netflix? You got to buy it or you got to short it. It's kind of hard. If you looked at Berkshire today, it's not hard.
Yeah. So you might ask yourself, there's a logical inconsistency in what I just said, which is I would never buy Netflix today with any fresh cash, right? I don't own it now. But I just said I'd own a 3 or 4% position. I wish, that I bought 6.5 years ago, and I acknowledge that it is inconsistent and that there's a lack of logic there. But I'm just telling you, and my advice to you as an investing is if you find something and it's working, and not just the stock is working, the key is the fundamentals have to be super strong. The story has to remain intact, because otherwise, if you're not following the fundamentals, valiant can happen to you. Okay, Valiant, everybody just remembers the big collapse. It was a 20-bagger in 6 years on the way up to 263 where it peaked before it went down by 97%, right? So the single biggest mistake that the investors who were in early and made a lot of money on the way up, the mistake they made is they fell in love and they got emotional about it. And they fell in love with Mike Pearson, they fell in love with the roll-up story and the cost-cutting story, and then they failed to see that the story changed. It was a very simple strategy of make acquisitions, slash costs, and jack up the prices of the drugs. And it was sort of a cynical way of gaming our fucked up healthcare system, right? That's what Valiant was. Mike Pearson was a McKinsey consultant who figured out a way to game the system. And he took an obscure little company and built it to this behemoth, and the investors who figured it out rode with him for a 20-bagger on the way up. But then the Allergan deal broke, and there was nothing left to buy. That was going to be the crowning big deal, and you could have had another step up if they'd been able to acquire Allergan. Once that deal broke, I would argue the story's over. You got to get out. Okay, but even then, the stock still had a little upside to it. It was when Martin Shkreli came along with this bozo who jacked prices up so ridiculously. It drew all this negative attention. And when both presidential candidates were saying we got to rein in drug prices and all, you knew the jacking. So the two pillars of Valiant's 28-bagger on the upside were now blown out, the acquisition pillar and the jacking prices pillar. And it wasn't that hard to see. And guys like Jana, there's some smart guys who were in it. They knew it, they knew what Mike Pearson was doing. They figured it out. They didn't fall in love. There's like, I think what he's doing is sort of scummy and he's just gaming the system, but you know what, it's working. By the way, how much did Valiant's profits go up? When the stock went up 20x in 6 years, how much did operating income go up? About 20x. In other words, it was legit. It was legit. Mike Pearson figured out, it wasn't legit, the strategy was sort of scummy, but profits really did go through the roof and the stock followed, right? So all you had to figure out though to get out is that the two main things driving profits had just got obliterated, and it didn't happen suddenly. The two events happened almost a year apart. The Allergan deal fell apart, and there's another year before the drug pricing scrutiny. You had all day long to get out.
Actually, Allergan published a deck.
Yeah. Go Google Allergan, right?
Allergan, response to Valiant.
Allergan response to Valiant. Go Google it, pull up the slide deck, and they just lay it out right there.
And they were right on the money, and it was a year early, and they explained everything that Valiant was doing that was going to blow up. And it was read it.
Yeah, and it was a good enough deck that they were able to nuke the deal and not get acquired by Valiant. That was super smart of them. But it wasn't like any of this was some great secret. So that's the key. Ride your winners. Trim them, manage the position size, whatever you can sleep with that's not crazy. Ride your winners. Even if you wouldn't buy them with fresh cash, don't fall into that trap like I did. Ride them, but keep a real close eye when the growth story's over, when the model is broken down, because then you got to get out. Don't fall in love. Okay, fall in love with Warren Buffett and Berkshire Hathaway, but don't fall in love with anything else.
What I can't understand to this day how such bright people walk over far from certain.
Glenn Greenberg.
Pardon me?
And Glenn Greenberg
What's
is amazing. That
Paulson was in it.
John Paulson, obviously Bill Ackman, and who was the fifth guy?
Jeff
Ubben.
Value Act.
Value Act. Those are the five of the smartest investors in the world. Collectively, must have lost well over $10 billion on this. It's the world's greatest case study. It's our favorite case study that we teach in our boot camp. Is doing a deep dive into Valiant, figure out what's going on, because this gets back to this. Yeah.
Correct me if I'm wrong. I would guess because these guys had so much money, they had to put it to work someplace.
I think they believed.
No, they genuinely.
And they weren't open to disconfirming evidence.
They had made a ton of money on it, and now you might say Bill Ackman was the exception because he didn't get into Valiant until 196 was his average price coming in. But keep in mind, he was rolling over the profits from $2 billion he made with Mike Pearson teaming up with Valiant to make a bid for Allergan. So every single one of those investors made a huge amount of money. And I'm telling you, here's a lesson, tuck it away. It will save you if you learn it well, which is if you ever make a ton of money doing something, buying Bitcoin, okay? I don't care. Whatever it is, if you make a ton of money doing it, I guarantee your brain will turn to mush and you will think it is the greatest thing ever, and you will be completely blind to the fact that, you know, Bitcoin is a ridiculous thing that's worth nothing and you're going to lose all your money. You will ride that thing all the way down into the ground, right? So be super careful, especially earlier in your career, if you have a lot of success doing something, and make sure that that something isn't just sort of dumb and you didn't stumble into something. That's what happened to me. You know, I was speculating in internet stocks in the late 90s. That's what inspired me to start a hedge fund. I thought it was God's gift to investing. I was just a late 90s bull market genius. Here we are 10 years into a long bull market where the theme of the last 10 years is super simple, is the more risk you've taken, the more money you've made, okay? So in other words, the dumbest, most ignorant, reckless investors who have no clue about value, who used the most leverage, who used options instead of buying stocks, who speculated in cryptocurrencies, the dumber you've been the last 10 years, the more money you've made. So there are a whole lot of people out there who have learned all the wrong lessons and are going to get destroyed. So I hope that's not a you. Yeah, go ahead. You know.
I'm not in the industry, so sorry. My questions
No
are
worries.
basic. But do you hedge in options?
So the question, do we hedge with options? We used to.
Never worked.
We tried. We lost a lot of money doing
I would say
it.
we lost money with options. It's different than hedging.
Because sometimes we went long just to buy things. We used options rather than stock.
Hedging's a very tough concept. I believe in alpha shorts. I believe in alpha longs. Making money on the short side, making money on the long side. But to have a great idea on the long side and then trying to figure out, well, how can I offset the gains that I'm going to make if it works, just as a little bit of a contrary concept. Now, there are situations like stubs where you buy Liberty parent company and short Liberty Global, and you're creating a business entity within there. That's sort of like a hedge, but outright hedges, we never did anything well.
Yeah. My general view on options is one of my friends, and this is one of the few quotes that I'm not quoting my friend Chris here, is options are like heroin. They feel so good and they will kill you. That's what one of my friends said. I always remember that. What is it? 70–80% of all options expire worthless. 70–80%. Think of it. I mean, you think just
that's a headwind.
Just think about buying every IPO. You're going to lose a lot of money, right? Every study ever done shows that. Options are much worse. You lose 100% of your money about 80% of the time. Okay. So why would you ever do that, right? And the answer is occasionally, like if you own a stock on the long side, maybe you sell some covered calls and create some income. You know, our friend Zeke Ashton at Centaur does that pretty well. You know, you've given up the upside, and that can be a real bummer if a stock gets called away, but you're starting every year plus 5% if you do it cleverly. So that's not unreasonable. Glenn and I did have success with one kind of options in our career, and we did a lot of dumb things and lost a lot of money. The one time we had success in options was finding a great stock like Berkshire, Anheuser-Busch, Canadian Pacific, any others you can think of, where we bought 5-year in-the-money call options as opposed to buying the stock. And because they were low-vol stocks, and because we were very certain that earnings were going to roughly double, or the stocks were going to roughly double in 5 years, it's 15% a year, but we thought there was a very low risk of a bad outcome. So we'd buy a 3 or 4% common stock position and then buy a 2% option position, where in the case, for example, of Canadian Pacific, the stock was at 100. I bought 5-year 80 strike call options, meaning, and I paid $40, meaning the stock was already $20 in the money. The option was $20 in the money because it had a strike at 20, strike of 80, stock was at 100. So it's $20 in the money and I paid $40, meaning in the next 5 years, if Canadian Pacific stock went from 100 to 120, I broke even. Now, I wasn't getting the dividends, so maybe that's a few percent a year different, right? But you know, this was the stock had already doubled from 50 to 100, but you got Hunter Harrison in there. Bill Ackman had just taken over the board of directors. This guy, Hunter Harrison, was that good. And so I just felt like, wow, there's a lot of upside here, and these options are really cheap because it's just sort of a big cap, low vol stock, right? So everyone, you know, we had some pretty good success with that. But, you know, Bill Ackman lost a lot of money in his Target side fund, for example. He raised, I don't know, a few $1 billion, $3 billion. And he,
Lost most of it.
well, yeah, he had, I don't know, 2-year call options, and he was going to go in and be the activist. And the options gave him control of a lot more stock, which enabled him to be a more effective activist because he had a bigger notional position. But also, he just wanted to make a lot more money. He was convinced that the company would do what he wanted, spin off the real estate into a REIT. That would unlock all this value and all. And the company, one, fought him off, but two, the Great Recession came. The stock dropped, I don't know, 20 or 30%. It actually probably outperformed the overall market in a terrible economic downturn and stock market downturn. But because he owned most of his position in options, he lost 80% of his money permanently. Okay. Whereas if he just owned the stock would have gone down 30%, and then it went back up, and he would have been fine. He and his investors would have been fine. So using options turned, you know, it was some bad luck. They were certainly running into the greatest economic crisis in a generation. But by using options, you now not only have to be right on the stock, you've got to be right on the timing. And it's hard enough to be right on the stock. So my suggestion is you never buy or sell an option in your entire life. You will lead a much happier and more profitable life. Yes?
So I want to go back to the, like the feeling about when to fall in love with the stock and when don't. Let's go back to Berkshire. Chris made a wonderful decision to stay with Berkshire. Mm-hmm. Do you have a checklist right now when you look back, look at the mirror every 3 months and ask some questions? When would you get out from that stock? Like if, for example, Value, right? So Bill Ackman, it's very smart, but he still couldn't get away from that. Based on experience, have you developed any kind of checklist, talk to Glenn and talk to somebody to have a, you know, checking your thesis, things like that?
Yeah. I don't have sort of a regular check-in checklist, nor do I have a written checklist I can share with you. We do have some slides on this about that we teach in our boot camp on the high class problem of, you know, at what point, how do you manage risk on a stock that's going up? What makes sense in terms of position size depending on stocks, and just, you know, having you obviously, to own anything, you should really know it well, and you should be able to figure out, okay, here are the key pillars, here are the key drivers of value, and just be regularly tracking them, right? And just sort of being comfortable. Okay, the story on Netflix, all the key pillars of subscriber growth, pricing power, developing original content, expanding successful internationally, boom, 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 everything's A+, right? And so I'm going to keep writing this. It's just a question of, okay, given the valuation's gotten pretty nosebleed, it's a pretty volatile stock, maybe, you know, for me to sleep well at night, I'm not going to let this become bigger than 5%. You know, okay, whatever, right? It's much more important to have a checklist and all. If you've lost a lot of money and you're trying to figure out, you know, you can do 3 things. You can buy more, you can just do nothing, or you can trim or sell, right, or exit, right? And the problem is the emotions there are so tough when you're losing money on something. All the blinders go up, and it's very hard. Human beings in general suck. We all suck at admitting when we made mistakes. And especially if you've made mistakes publicly, especially if you've lost money, it becomes much, much harder. So you just have to understand, all of our minds are pretty well hardwired to put up blinders and not see the disconfirming information, which is why I say when you're losing money on a stock and you're trying to figure out what to do on it, you have to start with the working assumption to try and overcome all those blinders. You have to start with the working assumption that you've made a mistake. The market is telling you you've made a mistake. It's beating you over the head with a 2x4 every day, telling you you've made a mistake because you've lost half your money, let's say. And then you need to go back and almost re-underwrite that situation. And you have to say, okay, if what were or are the key pillars of my investment thesis, and make sure you don't get thesis drift. It's super easy to buy something for 3 good reasons, and then 2 of those reasons get blown out. You think the CEO is a great guy, and it turns out he's a bozo. Well, okay, there goes one of your pillars. But the stock can still be cheap. You can always replace a bozo as a CEO, right? But you start inventing new reasons, and that's super dangerous, right? So you have to make sure you haven't fallen into the trap of thesis drift, and you sort of got to go back to the fundamentals. And sometimes the market's really crazy, but you got to start with the assumption that the market is clearly telling you something. You have to assume that the market is right and almost re-underwrite that situation. So how do you escape that? Number one, these mental traps, and think logically. Number one, assume that you're wrong. Start with that. Number two, talk to your friends. Share your investment thesis. Write it up. Post it on Value Investors Club. Post it on Seeking Alpha. Write it up and send it to your friends, and they'll shoot holes in it, right? That's a good technique. Go back to whatever. In the case of SodaStream, the key value driver that kept me in that stock was CO2 refills. So SodaStream, carbonates. It's a water carbonation machine, and the CO2 refills. It's a razor and blade business model. So they sell you the machine, they don't make much money, but where they do make money is every time you carbonate a bottle, that's done with a CO2 cartridge in the back of the machine, and about every 30 bottles that you carbonate, you got to replace the CO2 cartridge. And that's where they make all their money, selling you replacement cartridges. And every quarter, they report their number of cartridges sold. And so it's like, Gillette's business is track the number of razors sold, and that's a pretty good metric, right? So in the case of SodaStream, that was where that number, even as the stock went down by 70%, keep in mind, I bought it after it had gotten cut in half. I thought it was really cheap. It had gotten down to a cheap level. By the way, it was cheap at 35. Company just got bought for 144 two years later. Okay, but it turns out, I thought I was buying it cheap, and it got a lot cheaper. But I went back and I sort of ignored the noise. They were being targeted by divestment people because they had a plant in the West Bank that they were relocating into Israel proper. Their marketing in the US was screwed up. There was lots of noise that caused investors to just puke this stock out. But I just kept looking at the CO2 refills, which is an unbelievably great business. It's the driver of their business. And the CO2 refills were just going up 10 or 15% every quarter like clockwork. Go back the last 10 years. Every quarter like clockwork, that's gone up 10% a year. It's an incredible business. And all the rest was noise. Right, so you got to figure, if you're going to stay in and you're going to say the market's telling me I'm totally wrong, if I'm going to dig in my heels, there's got to be something that I've got super high conviction on like that. Yeah.
How much do you value the CEO's influence on the company when there are large fluctuations, like the Me Too movement? CEOs are being knocked down left or right, or Tesla, we see Elon Musk imploding. How long do you stick with the company stock?
Yeah. Well, the short answer is the answer I give to everything. It depends. The longer answer, are you asking sort of in general, how much do we weigh our assessment of the quality of the CEO overall as part of our thesis, or specifically if you have a controversial CEO? If I owned or was short Tesla, how heavily would I weigh the fact that Elon Musk was dumb enough to smoke a joint on live YouTube streaming, right? Is that relevant, or is that noise? It knocked the stock down 6% the next day. And that's a different question. What's noise and what's not.
I'm curious because you mentioned meeting with CEOs, so
yes.
I'm assuming that you're keeping track of movement.
Well, we haven't met with the CEOs of Google, CEO of Google, but we think we can analyze it and understand it.
And yeah, and making an assessment of the CEO does not require meeting the CEO for sure. In fact, there are some, Modish Pabrai, Guy Spear, I think, that never meet the CEOs because most CEOs are pretty good salespeople, and they genuinely believe that they're going to hit their numbers and profits are going to double. The CEOs are the last people on earth often to see that their business is completely falling apart.
And even when they're falling apart, their objective is not to express that to the marketplace. Their objective is to give a very calm outlook, because it's self-fulfilling if they're telling it's a disaster.
Some CEOs are total liars, but sometimes they will say ridiculously, obviously provably false things. But if you hook them up to a lie detector test, they would pass. Like, you know, all the human emotions about, you know, this is my baby and my business, and I'm this great CEO, and I'm going to double profits, even though the market's falling apart.
Right, but I guess what I'm asking on average is have you seen over time, is there a length of time where it might cause a bubble if you were to analyze their stock? You know, that there's a little bit, there's a market reaction, there's a public, public contextual reaction to it, and then the stock calms down, or they're going to name a new CEO, like for example, CBS.
I'm sorry, CVS?
CVS.
CVS with Les Moonves.
Right.
Yeah.
They're talking about keeping him there as an advisor. You know, how long is that? Do you have a sense of evaluating the impact of the CEO's position?
Yeah, I mean, I will say it depends on the situation. Sometimes the CEO is almost irrelevant to my investment thesis. Other times I was betting on Buffett. You know, he has today our valuation of Berkshire Hathaway does not have any Buffett premium built into it. But certainly over the last 30, 40 years, assessing him was critical.
Our views, you care.
Yeah. It varies. It varies. Generally speaking, we did not have good access. Like these days, you can just go out and you can listen to company conference calls, usually their YouTube videos, etc. Figuring out one of the key challenges that, especially in this world today where everything is online and we're drowning in information. I'll tell you, when I first started my career 20 odd years ago, finding good investment ideas was a big part of the value add, and then being able to collect information was a big part of the value add to my job. Today, it's the opposite. It's being able to, there's no value add to collecting most information, and we're drowning in it. So one of the key challenges all of us have is to figure out what are the 2 or 3 things. It's usually not 10 things. Maybe it's 4 or 5 things that are going to determine whether this is a successful investment or not. Figuring out what those things are, and then focusing all your energy on thinking about those things, and having the mental discipline to block everything out. Now, everything else out. So they did a study of guys who who handicap horse races. It's a beautiful study of odds, because they would what they would do is the handicappers for horse races generally factor in, they asked a room full of handicappers, and they said, what are the factors that you consider when determining, which horse is the favorite and which horse is the long shot, which horse has 2-to-1 odds and which horse has 100-to-1 odds of winning the race, right? And they say, okay, the horse's track record, the jockey's track record, the length of how long the race is going to be, is it muddy, et cetera, right? So all the handicappers agreed on 40 factors that they might conceivably look at, okay? And then they said, what are the top 5 factors, the 5 most important ones? And they all agreed, okay, these are the 5 most important ones, and here are the other 35. So then they split the room in half, and they actually took the upcoming horse races coming up on Saturday, and they gave one group of handicappers the 5 most important pieces of information, and they gave the other group those 5 pieces of information plus the other 35. So one group had 8 times the amount of information, right? But they both had the same 5. So then they asked the handicappers to set the odds, and then they ran the races on Saturday. So which group of handicappers do you think was more accurate? The ones who were blocked out. They didn't have the other 35, they just had the 5. Which group was more confident that their predictions were correct? The ones who had 40 had double the confidence, but were slightly less accurate. Not hugely less accurate, but the key was they were double the confidence, i.e. as hedge fund managers, they would have held 10% positions, not 5% positions. They would have overbet their hand. So in other words, having too much information both can actually lead to, one, sucks up a lot of your time, pollutes your brain, can lead to less accurate forecasts because you get distracted by factor number 23 instead of focusing on the big five. But the extra danger is that you become, by going out and interviewing 50 store managers, not 5, it leads you to become massively overconfident, and you overbet your hand, and then okay, so now you've oversized something, so you make worse decisions, and you've oversized worse decisions, and I can tell you, this was not part of this study, but I can tell you, you're having collected a lot more information. You're going to be a lot less likely, because you're now much more overconfident. You not only overbet going in, but the blinders are even bigger, and you're much less likely to recognize your mistake and fix it. So this is a big problem in a world now where we're drowning in information. And so this sort of gets back, though, to, is the quality of the CEO might be one of those 5 factors, and you need to make a good assessment there. And we've gotten burned when we've made some bad assessments.
And it depends on your personal read. I'm a terrible read of CEOs. Whitney's far better than I am.
I don't think I'm very good.
I can get fooled by anybody, but
Yeah.
I know it.
I like everybody too.
No, I don't like anybody, but I get fooled by them all.
So we actually have to start trying to demonstrate.
Yeah.
We're going to get kicked out.
Yes, at what time?
Well, we have that slot till 8:30.
Okay. So why don't we do this? Why don't we just run quickly through 2 stocks, or the 3 stocks, through the slides. We're gonna share the slides with you, and you can go through it at your leisure. But can you do Berkshire in 7 minutes, and I'll do Google and Facebook in 7 minutes, just as a give you a quick taste of it, and then we can break, and happy to answer more questions, during cocktails. But we can probably go a few minutes over 7:30. But we get kicked out of this building at 8:30, and we just want to leave some time for chit-chatting and so forth. Sorry we're losing folks on the webinar for that, so maybe we'll stick a few extra minutes here. So go ahead, Glenn.
Okay, so Berkshire Hathaway. I'm going to go through it very quickly. The basics, today the stock's $322,000 per A share. The B shares are 1,500th of that, or $215. Shares outstanding, 1.64 million shares. They don't split their stock, so that's why it's compounded up to that level. Market cap of $500 billion. You can see some other key metrics there. Book value is $217,000 per share. So it's trading at 1.48 times book value. The 9th largest company in the world and 3rd largest company in the United States by revenues. That's astounding. And the punchline is, we're not pounding the table, but if you want to sleep well, you want a good, solid stock that you're not going to worry too much about, and a very good chance of beating the S&P 500, because it's a collection of businesses that are on average far better than the S&P 500. Berkshire probably fits into that category. Chris pointed out that the price to book, there was a threshold set of 1.2 times. They took that, Buffett and the board took that threshold away, and recently he was on TV saying that he bought back shares. If you triangulate when he said it and where the stock had traded relative to certain public announcements of the company, he was buying the shares at north of $300,000 per share. I don't think he's buying today. But he's buying it north of $300,000 per share, and he's buying at what he thinks is a 20% margin of safety. That means that the shares are somewhere between $370,000 and $390,000 of intrinsic value. There's basically 2 components of value. There's the pictures, and there's the numbers. The pictures are wholly owned companies, largely insurance companies, core industrial companies, some retail. And then shares in well-known public companies. This was as of the end of the last quarter, but you can see $200 billion of stakes in public companies, the biggest being Apple, which that went from 0 to the biggest stake in the portfolio over 2 years. So he knows how to recognize an opportunity and to go big into it. The key story of the last decade is Berkshire's non-investment income has soared over time. So they're an insurance company. They take in money from people, and they hold it until they give it back to people. That's called insurance float. They put much of that insurance float into fixed income opportunities, and that's investment income. The non-investment income, the green bar, is the wholly owned businesses, the railroad company, the retailers, the regulated businesses. And that's grown as Berkshire has made more and more acquisitions. The core Berkshire strategy is to buy cash generative things. So if it's stocks, cash generation is generally in the form of dividends plus capital appreciation. If it's businesses, they're cash flow generative businesses. That means that there's just a torrent of cash coming into Berkshire every year, and they put it to work. They like putting it to work into wholly owned businesses, and that's why that green bar has gone up so much over time. Earnings and investments per share have steadily risen. So when you value Berkshire, there's actually two core elements of value. One is the investments on the balance sheet. The simplest one to understand would be cash. Cash is worth cash. There's marketable securities that are held on the balance sheet. There's fixed income held on the balance sheet. And then there's the pre-tax earnings of the operating businesses, and that's the red bar. And as you can see, they've focused on both of these elements, and they've grown very, very nicely. In this case, over 18 years. So Chris had pointed out, we kind of triangulated how Buffett recommended that people value Berkshire through various annual reports. He made certain comments. So as I pointed out, there's two components of value. There's the assets, which is cash and investments per share in the second column here. And there's the earnings of the wholly owned operating businesses, which is in the second column. And intrinsic value for Berkshire is just like any other business that has those two components of value. It's the assets, they're worth what they're on the balance sheet for, and a capitalized version of the earnings. In our case, what we do is we put an 11 times multiple on the pre-tax earnings of the business. So in 2017 at year end, it was $201,000 per share of assets of cash and marketable securities. And there was 12,900 of pre-tax EPS, multiply that times 11, add those two numbers, and we get an intrinsic value per share of $343,000. How has that calculation worked over time? Well, the red bar is the calculation of intrinsic value, and the blue bar is the stock price. So, lo and behold, in 2000, there was an opportunity to buy Berkshire somewhere around $40,000 per share when the intrinsic value was closer to $60,000 per share. And it bounced right back up. It was 50% return on your capital. In 2008, you could see that there was a wide gap that developed between the stock price and intrinsic value. In 2012, the same sort of thing. The last really big gap was in 2016. But if you know a stock really, really well, you do all the analysis, and you can put together a chart like this, it's really not hard to be a really good investor if you're going to be going in and out of something like this, because you look at where's the discount to intrinsic value at a sufficient level that you want to go into it in big size, and then the intrinsic value gap shrinks, and you may want to shrink your position or not. Now, what Chris did is he rode the blue line, and that was a fabulously successful strategy. What Whitney and I did is we tended to try and pick the cheapest points and then write it back up to when it was and sell at intrinsic value or so. So what do we think? 12-month investment return. We think that the current intrinsic value is around $365,000 per share plus 6% annual growth. That's what we just think those businesses will grow at. Plus they'll build about $10,000 per share of cash. And that gets you to intrinsic value of just shy of $400,000 in a year, 23% above today's stock price. So that's not too bad, 23% return in a year. In conclusion, everything you look for in a stock: safe, cheap, growing at a healthy rate.
Do you want to take a few questions on Berkshire?
Sure.
Maybe a couple, and then we just want to make sure we get through.
The question I would have is in regards to them buying back the stock because less than intrinsic value. Do you see an issue with the public companies that hold that they buy back stock as well? So, like, I see it as a form of leverage.
Right. So stock buybacks can be hyper intelligent and they can be really, really stupid. So if you're a technology company and you're just issuing shares to employees as compensation, so it doesn't flow through the cash flow statement the way salary would, but you want to offset the dilution from those shares with buybacks. That's how some people buy back shares. That may or may not be intelligent. I I don't, it depends on the price. If you're buying back Berkshire shares if you valued it and you're buying it back at 75 cents on the dollar, every share you buy back is accretive. Now, if you're borrowing money to buy back, yes, you're increasing leverage, and that may not be a smart thing to do. In Berkshire's case, they're generating $20 billion of cash kind of gushing into the company every year. They got to put it somewhere. They can buy some companies, they can invest in Apple, or they can invest in buybacks. Frankly, I would rather they buy back shares of themselves rather than make investments in the public markets in companies that aren't as good as Berkshire's. Berkshire's a wonderful company. They're generating more cash than they can put out. So that's the best thing from my perspective for management to do.
So you don't see an issue in them holding Apple Foods, doing very active buybacks, and I'm sure a lot of those other companies, their public holdings, are doing buybacks as well.
Well, Apple is a very cash-rich company, right. So they're trying to figure out what to do with their cash as well. And some activists and the board figured out that putting cash to work by buying in shares and by paying dividends is the best use of capital for their shareholders. I would imagine that Mr. Buffett agrees with them on that. We have seen too many to count situations where companies bought in their stock at, I'll just remember, at $40 a share, and then it went to $30 a share, and then they went crazy buying it at $30 a share and levered themselves up, borrowed money to do it, and then they traded at 20, and then they were at 10, and now all of a sudden they're stuck. They got debt that's coming due, they're not generating cash, and they're sunk. So it's a big mistake to stretch to buy in your own stock, even if it is cheap. It's a stretch. But if you have plenty of debt capacity, plenty of borrowing capacity, or free cash, it's one thing to do, and you should make the choice rationally. You should look at what's your return on capital invested in the business versus what's your return on capital buying back stock. And one of those two investment decisions is going to be a higher return opportunity, and you would expect that a good manager would choose the higher opportunity.
So I just wondering if you could talk about how you choose 11 as your multiple, and then how does it change over the cycles?
Yeah, that's a great question. Why do we choose 11 times as the multiple? The original multiple was the reverse engineering of when the annual letters from Buffett came out and said our stock's overvalued
to
today.
The stock chart, and so we can sort of point where we should be.
So
the chart itself.
So we sort of triangulated in that he used 12 because one year, he said our stock's overvalued, and it looked like the number was 15. And another year he said the stock was undervalued, and it looked like it was 8. And we sort of triangulated between those two. And
we have a slide on that, but this is a much trimmer slide presentation. We can send you guys, or it's posted on the internet.
So we used 12.
Yeah.
Then
during this entire period up to that year.
Yeah, and then up to about here, there was a revaluation of most stocks in the market, and we moved it down to.
The market went down 50%, so we moved this down from 12 down to 8. It wasn't actually the Berkshire's, our estimate of intrinsic value. It wasn't the Berkshire's profits went down so much. We just said the S&P 500 went down by 50% over this time period, so we marked Berkshire's multiple down by 1/3.
And then as through the recovery, we moved back up to 11.
Then, yeah, right, up to 10 in here. So it was 10 in here, and then we moved it up to 11, which, keep in mind, 11 pre-tax, multiple in a now a 20% tax regime is 14 times earnings when the S&P is trading at 18 times earnings. So we're still valuing Berkshire now at a significant discount to the average stock in the S&P 500. And trust me, Berkshire is a wildly better business with more stable cash flows and solid growth and safety. It should trade at a premium. So we think we're being pretty conservative in the multiple. Let's get one more.
Can you walk me through? I bought Kase each year from August 22nd, 2011, and I sold them on June 23rd, 2017.
Sure. So you bought Berkshire right in here, This is the stock price, right? Somewhere in here, and then you sold in 2017. So, you bought the B shares, but it looks like roughly a double. Congratulations.
It was, they just bought Burlington North at the time.
Mm-hmm.
They had a 30-to-1 split.
Yeah, because it had already been a 50-to-1 split, and then they did another 30-to-1. So the A and B is now a 1,500-to-1 difference. So maybe you were clever enough to buy on this dip in here. This was maybe after, I'm trying to remember when the Burlington Northern deal, the markets thought
2000
was
2010. That big spike in volume.
Okay.
And the reason it got screamingly cheap is because people thought that he was overpaying for Burlington Northern, and that's the best you can do in a financial crisis. Was sort of the thought process to buy a cyclical industrial company that's very capital intensive, and he recognized that that's not what
Right after I bought it, Warren himself bought it with a higher price than mine. I did. So
You mean he bought back stock?
Yes.
Yeah. Maybe he was following you.
1.1.
Great minds think alike. So why'd you sell it? Okay.
One last question. Now, obviously, if you invested in Berkshire as over the years, you're investing in the person, the CEO, Warren Buffett. He's now what, 80 something.
88 as of 2 weeks ago.
Yeah. When do you start, I guess, trying to factor that in? I mean, obviously, it's still going to run as a great business, and the two guys that you hired are smart guys as well, but they're no Buffett among them.
Yeah. We have a bunch of slides in the full deck that I can send you sort of talking about this, but basically, where on this chart it says we calculate Berkshire's intrinsic value, where's the Buffett premium? It's not there, we don't factor it in. So to some extent, we're valuing Berkshire, and we still think it's trading below intrinsic value, with assuming Buffett isn't running it.
So I would ask you, Chris, if Buffett decided to say, you know what, I'm getting old, I'm out, how would you still hold it for another 20 years?
He's presuming you live another 20 years. That is a great compliment.
I just should interject one thing. I had a lot of fun walking. I never dreamt they would live this long. But B, they've really institutionalized. If you think about it, all those companies can run themselves. Nobody's left. None of the managers, basically. It's highly unusual. Tech, it's up and out. And they love what they're doing. They can take options. This is the model that he has created. And I mean, look at the board. I mean, there's some fabulous people on the board: Bill Gates and Sandy Gottesman, Tom Murphy,
Walter Scott on the board?
Walter
Yeah.
Scott.
Yeah.
Merrill Whitmer, Sue Decker.
Sue Decker.
Great. So, they built a great organization. And,
There's a culture that will outlive them. It will be hard to replace Buffett. And in one of my slides, we talk about some of the ways, some of the risks that will the new CEO be able to keep the 76 operating managers tap dancing to work every day? There's something very special about working for Warren Buffett. There's also something about doing a deal with Warren Buffett, like the ISCAR guys, could have gone public and gotten a bigger price, right? But it's sort of cool to be the first people in Israel to ever sell their company to Warren Buffett. He probably got a little bit better price, right? When there's a financial crisis and you need this and you're trying to do a deal that sends a signal to the market that your company is going to survive, like GE and Goldman, having Warren Buffett put $3 to $5 billion into your company, or B of A, that would be the other example. That's different than some, a Greg Abel or whoever his successor is, or Todd Combs putting $3 to $5 billion into your company. So Buffett struck a better deal because it's him in that type of situation, right? So there are many ways that Berkshire will not be as great a company without Warren Buffett running. But as Charlie Munger once said, he's like, wait, so you've had Warren Buffett running this company, for 50 years, and he's turned it into one of the most valuable companies on the planet, and now you're going to bitch that it's not going to be quite as good a company when he's gone? Really?
well, he may be gone, but the money won't be gone.
Yeah, all the drivers are still there. Burlington Northern's still there, Coke's still there, Apple's still there, right? But it won't be quite the same company. The other thing, though, is he keeps, you know, we follow him closely. One way Berkshire could turn into a really crappy investment is if Buffett starts to lose it mentally, starts making very large, reckless decisions. If he were buying $50 billion of IBM and really doubling down on that investment, that clear value trap, one of the few letters I ever wrote to him about a stock where I thought he was making a mistake is I wrote to him as soon as he got into IBM. I said, you've made a mistake here. This is a total value trap, total melting ice cube, playing all sorts of accounting games, you know, please exit this investment. And you know, he doesn't appreciate those letters, but I felt so strongly about it. Eventually he recognized the mistake and he fixed it. And I'm perfectly happy that he's bought a lot of Apple, right? But if he were going out there, so my job as an investor in Berkshire is to carefully monitor some signs that some early stage dementia could be causing him to make some terrible investments. That could really harm Berkshire.
I see no.
I see no. He's better. He's better at age 88 than he was at 87, and at 80 and 70, he's getting better with age.
Better than I was at 27. He. I can't remember what I was about to say.
Speaking of early onset dementia. So let me just quickly run through, because we are running a little over, but I do want to just quickly run through you know, a couple growthier stocks that I've paid up for, you know, not in huge size, but you know, I've got my kids' college accounts right now, invested 1/3 in Berkshire, 1/3 in Howard Hughes, which is a real estate company that owns South Street Seaport that Bill Ackman is the chairman of, that we've owned for 10 years, and 1/3, 11% each in Google, Facebook, and Amazon. That I just think are incredible companies, going to keep growing, even though they're all, you know, in some cases approaching $1 trillion market caps or exceeding it in Amazon's case. So let me quickly just run you through two of them. So, you know, Google, I missed this early on. In fact, I was dumb enough to write an article saying it only has a fairly shallow, narrow moat. And in fact, it's one of the great businesses of all time. It has enormous moats around it. That's what revenue growth has done, up 35x in the last 15 years. And here's the thing, the revenue growth is accelerating. A company with $125 billion market cap. This is year over year by quarter percentage revenue growth, just astonishing. Margins, as it's grown and grown and grown, have remained remarkably stable, and these are depressed margins in my view because of all the stuff they're investing in these other bets. And so, not surprisingly, revenue goes up a ton, margins stay the same. Mathematically, your profits follow. Not surprisingly, the stock's been a huge winner, but it's actually trailed a lot of the other growthier tech stocks for sure. It's an incredible business in so many ways. It has more than 1 billion monthly average users of 7 different products, 90% search market in pretty much every country in the world. YouTube is an astonishing asset. Along with Facebook, Facebook and Google are attracting 100% of all incremental ad spending. All ad spending growth in the world is going to two companies, it's mind-boggling. You know, how dominant into every corner of every human being on earth this company is, and I think will continue to be. Here's some numbers on other bets that make it's even more profitable than it appears. What about valuation? Yes, you know, trade 24 times this year's earnings, which you subtract out cash. Other bets, any kind of valuation for YouTube, which they're not currently monetizing very well. Imagine if they just spun off YouTube, how much that would be worth. A lot. A couple $100 billion, easy, you know, would be my guess. It's
Waymo too. Waymo's
enormously spun it off. You know, so you know, you can fairly easily get to Google at 15 times earnings with some adjustments. From 24 times, and
Is Google buying their stock back?
I'm sorry?
Is Google buying their stock back?
I don't think so. See, what's interesting is businesses that cash flow like this, so at some point Google's growth is going to slow. But I can tell you exactly what's going to happen as growth slows. They're going to do just what Apple's doing, which is they're going to start paying a dividend, and they're going to start buying back a ton of stock. And that's another double in the stock right there, just doing those things, just what Apple's doing. And then they'll pull a McDonald's, which is lever up like crazy if you have
incredible stable cash flows, and then buy back a ton more stock, and that's another double in the stock, right? So they haven't even started to play. You know, companies go through phases of, you know, the strong organic growth, and then, you know, when that slows, the smart companies can start using their balance sheet and their cash flows, even if there's not a lot of growth, to create enormous value if they do it cleverly.
They did initiate a buyback, I'm wrong.
Okay, Glenn corrects that they did initiate a buyback, but it's not moving the needle at this point. They're not doing, and they're not paying a dividend, right?
No, they're not.
Yeah. So let's just take a quick look at Facebook, which was always trading at a big premium to Google. Now it's trading at about the same multiple, but it's about 1/3 the size. So I think there's a lot more room to grow. And you know, talk to any advertiser. I'm starting to get into the Google, Facebook with my business here, Case Learning. And Facebook is in many ways better for advertisers in terms of targeting and what they know about people. Facebook knows everything about you, like everything about you. That is ungodly valuable as an advertising platform. So astronomical revenue growth. The rate of growth is approximately double Google's. Google's growing 25% a year. Facebook is up here growing I think last quarter when the stock puked out, they only grew 42%. Double the margins of Google. And stock's down 26%, trading at the lowest valuation multiples in its history. Now, that's still a PE north of 20. It's still, still trading at fairly rich multiples, but for a company like this, and I know that my kids and my wife have switched off of Facebook, and now they're on Instagram. Well, guess who owns Instagram, right? So we're not even talking about the value of Instagram and WhatsApp here. So it's it has probably the greatest business model ever, and it's so it's my guess is that the multiple, it's now, Facebook is down to almost a market multiple for a business that still has some incredible growth ahead of it, I think. So looking pretty interesting. This is, I think, the single biggest opportunity. These are quarterly numbers. So take a look at the US and Canada. So that's about $100 a year. So all of us, assuming you're on Facebook, Facebook is selling about $100 a year of advertising revenue for each of its North America, US and Canada users. Okay. Europe has the same GDP per capita pretty much as US and Canada, and the monetization is only 1/3 as much. Asia Pacific, which isn't as high a GDP overall, but is about 1/10 as much, and the rest of the world is 1/15 as much. I think there's a very, very powerful trend in the world toward advertising migrating toward this around the world. And the way it's happening in the US and Canada, I think there's a pretty good likelihood the rest of the world for the next 10 or 20 years sort of starts to catch up. So there's still a lot of room for a number of users to grow, but the bigger lever is the monetization per user around the world. I think starts migrating slowly, may never get to the level of the US, but starts migrating in that direction. So I think this growth story, and keep in mind, roughly speaking, size-wise, Apple has double the revenues of Google, and Google has triple the revenues of Facebook. Facebook is 1/6 the revenue size of Apple, which gives you some sense of, okay, it might seem like, oh, the growth story's got to end here. I don't think so, not for a while. That's my guess. So those are two sort of growthy stocks that two value guys own. Probably some good sign of a top, but maybe not. Any questions on this? All right, why don't we break, and anyone's of course welcome to leave or just join us out there in the lobby for some drinks and snacks. And thank you so much for coming. And if anyone's interested in further information, any of our programs, you can go to caselearning.com or just go up and talk to me. I'll give you my business card, and happy to send you information. Yeah, one last question. No, Tesla. The Tesla question always comes up.
I mean, yeah, there is in the news everywhere.
Yeah, it was my, I'll give a short answer on Tesla, because we could spend all night talking about it. We can talk about it at the break, but Tesla was my worst short ever back in 2013. They were within, we now know, you can read the books, it was within a week or two of bankruptcy, and I thought they weren't going to make it. And they pulled a rabbit out of a hat and came out with a great car. Those were a big hit, and I got run over. I did not adjust my investment thesis. The pillars of my investment thesis got blown out, and I stubbornly hung on as the stock went up and up and up, and I got killed. Today, my view, I've been telling all my friends for the last 5 years, all my short selling friends have been shorting Tesla because it's like catnip for short sellers. I've told them this is a bad short, get out, do not short this stock. A few months ago, with that infamous conference call, the debt building up, for some reason they either are too dumb or somehow their hands are tied for some SEC something or other that we don't know about, for whatever reason, not raising capital as they continue to burn capital like this, I think is reckless. So I think I am no longer, I don't think it is a good short, but I am no longer telling my friends it is a bad short. I think the odds that this goes the way of Valiant have gone from 10% to 30% in the past few months. I.e. an absolute train wreck, a stock that goes down by 90%. That's about it.
Elon sold about $2 billion.
Did he?
Recently?
I'll say at least 6 months ago.
Yeah.
But putting all that aside, well, you shouldn't put this.
Come around
that
here,
is,
Glenn, if you're going to talk.
okay, so there's so many red flags.
The only person who spends more time on Tesla than me is him, and we don't own the stock. I don't know.
There's so many red flags, but what will ultimately hurt is every car maker in the world is coming out with really cool electric cars, and Tesla is their advantage is going to become their problem, which is they were the pioneers. So they used the technology that was available when they came out. And you know what their technology is? It's basically little lithium batteries, the kind that you would put in any sort of consumer electronic things, and just put a lot of them in.
Thousands of AA batteries that work together.
And that's what powers their car. There is battery technology now that is better and cheaper and easier to produce. So,
so Tesla had a first mover advantage, and they were really clever in going out there. But if you just look at and I think Tesla has been good for the world. I think it's been good for the environment. Tesla single-handedly has forced every major auto manufacturer in the world to spend billions of dollars coming out with and really throwing a lot of resources and making some incredible cars, which in the next, 12 to 24 months, the world, we are going to have so many options, some incredible cars at different price points and features, etc. coming out. This is going to become a very crowded space. Whereas Tesla has had it basically to themselves. I mean, come on, the Volt is not competing with the Model S, right?
So the Leaf is.
Boy, but yeah, exactly. So my cousin, who's an early adopter out in Silicon Valley, Stanford engineering kind of guy, whatever, he was in line for a Model 3. He canceled and got his money back because he's like, I can get the Jaguar I-Pace or whatever, and so remember iOmega back in the day, they were the first mover. Sometimes these first movers, you can be a Netflix, and the upside scenario to own Tesla would be somehow it's going to be like Netflix, where there's all this talk about these big lumbering companies, but somehow the little innovative smaller company manages to stay ahead of them. Stock's a 50 bagger, right? Keep in mind, stock's a 50 bagger starting from a $3 billion market cap. Tesla's got a $50 billion market cap today. But Tesla, maybe they can keep pulling rabbits out of the hat. They've been pretty darn good at it. I'm not sure I'd bet against it, but the story of capitalism generally is when the little upstart gets a couple-year head start and gets out there and investors get really excited, and then 20 gargantuan companies who can, by the way, subsidize the prices of these cars, come in. The little upstart, generally speaking, most of the time gets squashed.
Remember Palm Pilot?
Yeah. So those are our quick thoughts on Tesla. Generally speaking, you can lead a long and happy life, and actually one of the lessons we teach in our shorting seminar in particular in great depth is generally speaking, if you want to be active on the short side, avoid battleground stocks. Find stocks often that there are a couple strategies, but one of the smartest ones, I think, is one of the guys who came in and spoke to our students said, we own stocks that we short stocks that other value investors own, where we just think they're wrong, that the stock is a melting ice cube and the profits are going down, and they own it because they think so. We think we've identified a turn in their business, and the profits are going down. So we're not going to get killed if we're wrong. There's no hype, and they're not battleground stocks or whatever. We're just betting that as a perfectly decent company, if you categorize all companies in terms of quality and growth into 4 quartiles, A, B, C, and D, right? We're not shorting the A's, the companies that are really growing and people are excited about, and we're not shorting the D's, the stocks that are already down by 90%. We're hoping to catch the last breath down to 0, right? We're shorting the B's that we think are going to C's and D's, right? And that's generally speaking, finding situations like that are sort of off the radar screen, that aren't crowded, that you're not going to get your face ripped off with a big promotion campaign or whatever, or a super growthy thing that just, goddamn it, continues to grow, whatever. So I no longer pound the table saying you're an idiot to be short Tesla to my friends, but generally speaking, I'd say you probably want to avoid it. One good tip is don't ever short a stock where the customers are just passionate evangelists for the product. I made that mistake on Lululemon, for example. What are other ones where the passionate evangelists? Not that everybody, very few people have been dumb enough to short Apple or something like a Starbucks or a Costco or Southwest Airlines or whatever, but companies that just have really passionate customers, generally make bad shorts at any price. So with that, why don't we break, and thank you.
I hope you enjoyed this video. Again, if you'd like to learn more about Kase Learning and our programs, just go to kaselearning.com. And if you have any questions, email me at info@kaselearning.com. Thank you.